Hello and welcome back to the channel. I am Abhishek and I am thrilled to have you join me for another review lecture for CFA Level 1. Today's topic is Basics of Portfolio Planning and Construction for CFA Level 1 2025. I'll cover all the key concepts so that you can feel confident while attempting the exam. If you find this video useful, please hit the like button and subscribe to the channel so that you can get notified on my new videos. As always, if you have any questions, please drop them in the comment section below. Now let's jump right in. So in this reading, we'll be talking about the IPS investment policy statement. How do we come at the strategic asset allocations? What are the principles behind asset allocations? What are asset classes? How to consider the ESG factors? How to determine the risk tolerance of a client? Let's first talk about the IPS. IPS is basically the starting point of the portfolio management process. It communicates a plan for achieving the investment success. By investment success, we typically mean that you are able to meet the client's objectives. That's when we call it investment success. So the IPS helps to determine the client's objectives and the risk constraints. What are the constraints that the client have? The client constraints could be liquidity constraints, it could be time horizon, depending upon the client's particular circumstances. The objectives are specified regarding the risk tolerance and the return requirements. What is the client's return requirement? The return requirement could be stated on an absolute basis, also on a relative basis. Similarly, the risk could also be stated on an absolute basis and also on relative basis. A well-constructed IPS helps both the investment manager and the client. The investment manager should always build the portfolio complying with the IPS, and whenever an opportunity comes, the investment manager must assess the suitability while referring to the IPS. IPS is also a legal or regulatory requirement in some countries. The IPS, in case of institutions, IPS could also state out the governance arrangements. The IPS should also be reviewed when the manager comes to know about any material change in the client's circumstances. The material change could be related to his wealth, like if he inherits a considerable amount of wealth, the client's circumstances have changed. If he loses his job, that's also a material change in the circumstances, or if the time horizon or the liquidity needs change. Let's talk about the components of the IPS. The first component is the introduction. In this component, we basically describe the client, who's the client, what is his family background, what does he do, how he gets his income, all these things, like basically you are getting to know your client. Then comes the statement of purpose. This section, it basically states the purpose of the investment policy statement. Why are we creating this IPS document? Then comes the statement of duties and responsibilities. This section details the duties and responsibilities of the client, the custodian, and the investment managers. Then procedures. It explains the steps to take to keep the IPS current and the procedures to follow to respond to various contingencies. What procedures should we follow if there is a particular change in circumstances, if the time horizon changes, if the liquidity changes, or if there is any other material change in the client circumstances, what procedure should be followed? Then comes the investment objectives. In this section, we basically explain the objectives of the client. What is his investment objective? Why is he investing? How much return is he expecting? Then comes investment constraints. This section particularly deals with the constraints that the client has while investing. The constraints could be related to the time horizon, it could be related to the liquidity of his investments and all that. Then comes investment guidelines. In this section, we provide information about how this investment policy should be followed. What is the permissible level that the investment manager can use of leverage, how much derivatives can he use, how he can hedge his positions, and if there are any particular assets that he must not invest in, all those assets are also listed. Then comes evaluation and review. This section provides guidance that how the investment policy statement should be reviewed regularly. Then in the appendices, you get strategic asset allocation and the rebalancing policy. We'll talk about strategic asset allocation in some time. Let's talk about the risk and return objectives. The risk objectives are basically that how much risk can a client take, basically related to the client's risk tolerance levels. Now, the quantitative risk objectives can be either absolute or relative, or it can be a combination of both. In absolute risk objective, you are defining that how much risk can he take in an absolute sense, like you are giving out the standard deviation of the return or the value at risk measure or the variance. You are basically giving an absolute amount of these measures. In case of relative risk objectives, you are giving out the risk in relation to a particular benchmark, like your tracking error or tracking risk. These are examples of your relative risk objectives. Then let's talk about the return objectives. The return objectives can also be either on an absolute basis or on a relative basis. On absolute basis, you typically say that this much percentage of return should be achieved by the client, that is in the absolute sense, or it could be related to a particular benchmark, like you want to outperform the benchmark by 1% or 2%. That is the return objective in a relative basis. The return requirements can be stated before or after fees. It can also be stated pre or post tax basis. The manager must ensure that the return objective is realistic. It should not be that the client is expecting a return of 30 or 40 or 50% consistently. That objective is not a realistic one. The client and manager, they must agree on whether the return objective is in the nominal terms or on the real term basis. When finding out the risk tolerance of a client, there are two things to note. First is your ability to take risk, the client's ability to take risk. Then comes the client's willingness to take risk. While defining the overall risk tolerance, these two things must be in balance. Like if, let's consider this case, if the willingness to take risk is below average and the ability to bear risk is also below average, then we can say that the risk tolerance is below average. But let's say the client has the ability to take risk, client has a ability to take above average risk, but he is not willing to take that risk. He is willing to take only below average risk. So in this case, we must educate the client that you can take a little bit higher amount of risk so that you can get a higher amount of return. But you must educate the client and come to a certain conclusion about the risk tolerance of the client. A resolution is needed in this case. But if your willingness and your ability to take risk are matching, then there is no resolution needed. You can simply state if both are below average, that means the client has a below average risk tolerance level. If both are above average, then the client has above average risk tolerance level. Now let's talk about the different constraints that the client can have. First is your liquidity constraints. The liquidity constraints basically mean that how much of the portfolio should be liquid. This much part of the portfolio, it will be invested in the liquid assets. That means it can easily be converted into cash. These assets have low risk and they have basically low return. Then comes the time horizon constraint. The time horizon constraint basically means over how long a period can the client be invested. It depends upon the particular circumstances of the clients. Let's say if the client is saving for his retirement and he is currently only 30 years old, that we can say that the client has a longer time horizon. But if he is already 50 or 55 years old and he is saving for his investments, then we can say that the time horizon is very short in that case. The time horizon can also be change depending upon the family. Let's say if they are here, let's say if the son or daughter of the client goes to a college and they need liquidation of the funds, then the time horizon gets shorter. Next comes the tax concern of the investor. Now investors have different tax status. If one investor is taxable, he would prefer the long term capital gains instead of income, because he has to pay tax on the income generated from the portfolio. So he'll prefer having a long term capital gain, because capital gains are taxed at lower rate than the income. But if there's a tax exempt investor, let's say such as a pension fund, so a pension fund will be indifferent to both types of returns, because he is not paying any taxes either on the capital gains or on the income. So he is indifferent to both types of returns. Then comes your legal and regulatory factors. The legal or regulatory factors generally play out in the case of pension funds or in the case of insurance companies, because these companies have a legal requirement to be able to satisfy their obligations. So a legal and regulatory restrictions are also apply on how the portfolio is invested of these companies. Then comes your unique circumstances or the ESG considerations. Now, a client could have a particular ESG considerations related to ESG based upon his faith or his moral values or his religion. A client may have personal objections to certain products or practices, like he may object investing in companies which deal with tobacco or alcohol. They can exclude such companies from their investment portfolio. Gathering client information, this is basically the fact finding exercise that takes place at the beginning of the client relationship. This involves gathering information about the client's circumstances as well as his objectives and requirements. If the client is an individual, then it's also necessary to know about the requirements of the client's spouse and other family members. The health of the client and the dependents is also relevant in this case. In case of institutional relationship, it would be important to know about the key stakeholders and what their perspectives and requirements are. Information gathering could be done in an informal way, or it could involve structured interviews, questionnaires, or analysis of data. Now let's talk about the asset classes. What's an asset class? Asset class is basically a category of assets that have similar characteristics, attributes, and risk return relationships. That means a one asset class has similar assets. Let's say equities is a different asset class, debt is a different asset class. We can further bifurcate these asset classes. Let's say equity could be bifurcated into domestic equity, global equity. Similarly, debt could be bifurcated into long-term debt, short-term debt. So basically, the assets that have similar characteristics are included in an asset class. What is strategic asset allocation? A strategic asset allocation is the set of exposures to asset classes that is expected to achieve the long-term objectives of the client, depending upon the client's risk profile and constraints. So at the start, you define the asset classes. What are the permissible asset classes that the investor can invest in depending upon the IPS? And then, considering the return and risk objectives, you define a particular weightage that should be given to each asset class. Let's say for an investor, you decide on a 80-20 weightage of equities and debt. that 80% should be given to equities, 20% weightage should be given to debt. That is your strategic asset allocation. This asset allocation is the basis of your investments in the future. Now, the focus of strategic asset allocation depends upon a number of principles. The first principle says that the portfolio's risk accounts for most of its change over the long term. The systematic risk of the portfolio. Why systematic risk? Because the non-systematic risk can be diversified easily. So, the portfolio is not compensated for bearing the non-systematic risk. You are compensated only for bearing the systematic risk, and this systematic risk is related to the economic system and it cannot be eliminated by holding a diversified portfolio. The second principle says that the returns to group of similar assets, it reflect exposures to certain set of systematic factors. Now, how systematic factors? Let's say you are investing in long-term debt. So what are the systematic factors in this case? Your systematic factors are the interest rate changes, the credit behavior, the business cycle of the economy. So these are all your systematic factors. So a strategic asset allocation is basically providing the investor with exposure to systematic risk of asset classes in proportion that meet your risk and return objectives. Depending upon the client's risk and return objectives, we define the exposures to different asset classes or to exposure to different systematic risk factors. How do we come at a strategic asset allocation? First of all, we make long-term capital market expectations. Capital market expectations basically mean that how the capital markets are going to behave in the long term. In the long term, this long term could vary depending upon the investor. If we are talking about individual investors, it could be 4, 5 years, 10 years. But in case we are talking about endowment funds or pension funds, the long term capital market expectations could reach out to 20 years or 30 years also. We take capital market expectations on one hand, then we consider the investment objectives and constraints from the IPS. We consider both of these things and come out at a strategic asset allocation. Let's talk about risk budgeting. Risk budgeting is basically the process of deciding that how much amount of risk to assume in a portfolio, that is your overall risk budget, and then subdividing that risk over the sources of investment returns. Like how much of the risk should come from this asset class, how much of the risk should come from deviations from the asset allocation, how much risk should come from this particular security. Now, the return on strategy, it basically depends upon two other sources. We already talked about strategic asset allocation, right? This is the starting point of your investment strategy where we define the exposures to different asset classes depending upon the IPS return and risk objectives and constraints. Then we also talk about the tactical asset allocation and security selection. Now, what is tactical asset allocation? Tactical asset allocation is the decision to deliberately deviate from the policy exposures. That means you defined a policy exposure of 80-20, 80% to equity, 20% to debt. But now you are deciding that for this 6 months period, I know that my equities are going to underperform and debt is expected to outperform because I am expecting a rate cut by the central bank. So what I'll do in this case, I'll reduce the exposure to equities. Let's say I'll deviate the policy weight by 10%. I'll give the 70% weightage to equities and 30% weightage to the debt. But this is only for the short term period. This is just a deviation that I have deliberately made depending upon my forecast of the near term returns of these two asset classes. That is your tactical asset allocation. Then comes your security selection. Now, this is an attempt to generate higher returns than the asset class itself by selecting securities with a higher expected return. Now, if I'm investing 80% into equities, there are two scenarios. In first scenario, I can directly invest 80% amount into an index fund that is tracking my benchmark. So that is my strategic asset allocation. But I can also invest that 80% into different securities so that I can outperform the asset class itself. That is your security selection. These are two other sources of your investment returns. Now, as the portfolio is constructed and its value changes, your policy weights, your actual portfolio weights deviate from your policy weights. So that deviation is known as the drift. The actual weights drift away from the policy weights. So you need to bring those weights back to the policy weights. That process is known as rebalancing. You rebalance the portfolio so that currently the actual weights of the portfolio reflect the policy weights. The set of rules that guide the process of restoring the original exposures is known as the rebalancing policy. Now let's talk about how ESG considerations are integrated into portfolio planning and construction. There are 6 investment approaches in which we consider the ESG considerations. The first one is negative screening. In negative screening, we simply exclude companies or sectors based upon their activities. Like if I'm saying I don't want to invest in tobacco or alcohol companies, I'll simply exclude those companies. That is my negative screening. Then comes positive screening. Positive screening includes sectors or companies based on specific ESG criteria. Let's say if I'm saying I want to invest in green energy, that means I'm only investing in green energy companies. That is the positive screening case. Then comes ESG integration. In ESG integration, this is basically the integration of ESG factors into every decision making process, whether in asset allocation process, whether in security selection decisions, or in your portfolio construction decisions. You integrate the ESG factors into each and every decision. That is basically ESG integration. Then comes thematic investing. In this case, you are basically investing in particular themes related to the ESG factors. Then comes engagement or active ownership. In this case, you use your shareholder power to influence the corporate behavior to achieve your ESG objectives. Then comes impact investing. In this case, investments are made to generate a positive and measurable social and environmental impact. Let's say if you really want to tackle the let's say you want to tackle the pollution, and you are investing in those companies which are only dealing with the you are making investments on the basis so that you want to make an environmental impact. You are creating a new company, or you are investing in such a company that is dealing with those. So this is all for this reading. I'll see you in the next video, in which we'll cover the behavioral biases of individuals while investing. If you are new to the channel, please subscribe and don't forget to like and share this video. Thank you very much.